Hello, everyone, and welcome to this real estate financial valuation series. So, in this video, we are going to explore how leveraging a debt financing can significantly impact the profitability of a real estate investment. In this module, we will look at three scenarios to understand how different capital structures, ranging from 100% equity to high level of debt, can significantly impact the outcomes of an investment. So, we have estimated that in this model that the target acquisition or the target property value is 100 million, and we also estimated that the growth of this property will go up by 10% in the second year of acquisition. So I have built a three different scenarios with different capital structure. Let's look at the scenario one where the property acquisition as it's 100 million for as it is invested in the first year. In the second year, the property grew by 10% from and increased the value from 100 million to 110 million. Since we have not taken any debt financing, so the total investment for this project is 100 million without debt financing. So look at the return matrices. So my revised property value for the scenario one is 110 million, and my initial equity investment is 100 million. So the capital gain after the first year, during the second year, or by the end of the second year, the capital gain for this property is 10 million with a 100 million investment and 10% growth rate. So my return on investment for this project is 10%, and my equity multiple is 1.1. My figure is 4.8%. Now let's analyze the scenario two, where we estimated that the 50%, the total investment will be split between the equity and debt with equal 50% investment. So my property acquisition, the scenario two is remain same, and my property revised value will remain same. It also grew by 10%. The changes appears in the capital structure. Now I have a 50% equity and a 50% debt financing. Uh, so the 50 million split between initial equity and the debt financing. In the return matrix, we have a revised property value which is 110 million, but the equity investment is only 50 million. So my capital gain on this scenario is 60 million. In the first scenario, it's only 10 million. In the second scenario, it is 60 million. Okay. After the debt repayment, I still get the profit of 10 million, but my return on investment grew by 20%. Okay. Which is significantly high compared to the scenario one. My equity multiple is 1.2, and my annualized rate of return, or the CAGR, cumulative 0.54%. Now look at the scenario three. In this scenario, uh, we have a significant change. Our equity investment is only 10%, and our total debt will grow from 50 to 90%. So my property value, property appreciated value will remain same, except my capital structure is 10 and 90%. So my equity investment, which for the 100 million uh, property value, is only 10%, which is 10 million, and I'm taking a debt leverage of 90 million for this investment. Since my revised value for the property will remain 110, and my initial equity investment is 10, which resulted a capital gain of 100 million. Okay, my profit still remains same. The only effect is happening in my capital gains compared to my equity investment. My ROI is now 100%. My equity multiple is doubled, and my annualized rate of return is significantly jumped to 41.2%. So here, all the three scenarios. For example, the first scenario was 100% equity. The second was 50-50 split. The third was 10 and 90% debt. It has become clear how leverage fundamentally shape the profitability and the strategy of any investment. In the first scenario, it is the returns are very stable. and predictable. The investor carries no debt risk, but the return on equity is limited because the investment is funded purely by the own capital. In the second moderate scenario, where equity and debt are equally balanced, the investor begins and benefit from the multiplier effect of leverage. Less of their own capital is invested, yet they still enjoy the same appreciation on the full asset. As long as the property return exceed the cost of debt, equity returns are increased. In the highly levered scenario, where only 10% equity is invested, the return on equity becomes significantly magnified. A simple equity base capture the same gain, producing extremely high percentage returns. This highlights the true power of leverage in simplifying profitability. So, but it is also important that always greater leverage comes with a greater risk, because a high interest rate uh, uh, always comes with if the market condition change, uh, the fluctuation happens in the market interest rate, uh, the whole profitability scenario will result into a very adverse scenario as well, because if you have a high leverage, that means you have high interest obligations, greater sensitivity to cash flows, and increased financial risk. Okay, so in order to to having everything in mind, so the company usually comes with a great optimal capital structure that balance the financing and the equity investment for any project. Okay, uh, and the optimal capital structure is the point where the users of debt maximize returns on equity without pushing into investors into excessive or aggressive financial risk. So it is almost very clear that in real estate deals, the optimal capital structure lies somewhere in the middle, where debt enhances returns, but not to an extent where the threatens solvency or operational flexibility. So we'll see in the next lessons. We'll see how we can get a optimal capital structure for any investment. Thank you for watching the video, and we'll see you in the next one.